All right, guys, we on another episode of Free Game Fridays where I'll be dropping gems for free. Today, I'm going to give you $1 million worth of game for free. That's right. So today we're going to be talking about life insurance policies. All right. So at the end of the day, a lot of people understand life insurance policy at its most basic form. OK, and that is the death component. But there's more components to life insurance than just the death benefit. So let's talk about it. All right. The wealthy people know exactly how to use life insurance. And just so you know, some of the benefits of life insurance when you use it the right way is, of course, the death benefit. But then also it gives you money while you're living. And that's the part that I want to highlight today in today's episode. All right. So we're going to get right into it. So the first thing you need to know is the difference between the two different life insurance type of life insurances. So you have a term life insurance, and then you've got universal or whole life insurance. They refer to it as both. And so those are the two types. Now, under those two types are a lot of subsidiaries, but we're just going to talk about the two types real quick. So term insurance is when you buy insurance and it's pretty cheap, and you get a death benefit. So well, it has a death benefit to it. You don't actually get it. So when you die, whoever you leave your money to, whoever the policy, the beneficiary is of the policy, then they get some money. Okay. So really cheap, $1 million worth of insurance. If you're a 30-year-old person that's in good health, then it's going to run you about $30 a month. Okay. Sometimes $50 if you're in bad health. But at the end of the day, it just pays out that one component, okay, the death benefit. Now, whole life insurance is different. It gives you a life benefit. So let's say $1 million. At the end of the day, what that whole life insurance policy does is it not only provides you with a death benefit, but it also provides you with accumulative wealth in the process. In other words, it brings about money while you're living. All right. All right. So I'm going to pull up an illustration on the screen. And I want you to pay attention to a few things. So this is going to be an illustration of a whole life insurance policy for a healthy 30-year-old, right? The policy amount is going to run about a little under 10 grand a year. So that's about $800 and something a month, right? Now, I know what you're thinking. $800 versus $30, $40, $50 for term insurance. I recommend you do both whole life and term insurance. Okay. Now, for the whole life policy, it's the same as contributing to a 401k, but you're going to see how your numbers are going to jump and it's going to outperform a 401k. So if you look in year number 10, you already see that you're going to have $1 million worth of insurance that's going to go to your death beneficiary. All right. That stays the same. But if you go over a few columns, you will see that the accumulative value, or the money that you are having while you're living, we'll call that living money, that jumps tremendously throughout the years. So let's say that in year 10, after year 10, they really reward you and the numbers really work in your favor. So if you look at 20 years, so when he's 49 going on his 50th birthday, he's going to have $279,000 in that account, right? And by the way, he's contributed $195,000. So that's really good money. So this is a really good way to leave generational wealth. You can leave, like I said, $1 million, $2 million, $5 million, tens of millions of dollars to your beneficiaries. And it's tax free. So there are a lot of different ways to use insurance to get wealthy. So you guys already know what to do if you want to learn more about this. Me and my financial advisors are on deck to help you out. So that's really good money. That's a good return, because the contributions is right at $195,000 over 20 years. But then the accumulation value is $279,000. That's a really good return. Now let's go down the chart and let's look at retirement age. So let's say that this same guy, his goal is to retire at 55 years old. At that point, he would have put in $240,000 worth of investment funds, right? He still has this $1 million going to his beneficiary, but look in the other column. He's at $459,000 as a retirement gift to himself. You can't even do that in the 401k. Now, you're supposed to be able to do that in the 401k, but we all know that that doesn't happen. So just want to kind of give you guys the game.